bought the stock outright when you thought you had a bullish position?
No, it was put to me as I had a short.
Got it. So you were short a put and it was assigned.
And it was assigned.
Okay, and are you long a put also? Because I thought you said you were long a 57 put.
Yes, I am long a 57 put.
Right, so that's called a married put. So you should be in no pain right now because...
No, I'm at a loss.
But if you have the right to sell it at 57 and it cost you 53, your cost basis, but yeah, less the debit, of course, for you to buy the put. I get it. But you still have a married put, which is a bullish position with insurance.
I understand that.
Okay.
Put is now $384 profitable.
Say that again, 382 profit?
The put is $384 profitable.
Correct.
Yeah, and
but your cost basis is what you said. It's the $53 less the premium you received by selling the put. So let's back up. What are you wanting to do now? Are you wanting to close out the position? Are you wondering?
I'm wondering what to do now. I didn't have a good plan, and this was sort of not expected on a Thursday morning, especially after I've been all week.
Well, it's just like, I used to have an exercise for my my Lab 2 students. I would just arbitrarily give them positions, and I'm like, here, manage them. Use your skills and manage them. So you now have a position, which is, it's a bullish position, but it costs you money because when a married put, just for others, you buy a stock and you're buying a put for insurance, but the insurance costs money. So that's raising your cost basis. So let me use hypothetical numbers. You're buying McKesson.
Okay, I'm seeing that I'm getting it a little bit, maybe.
Okay, so
I paid $53 a share for the stock, and I paid $584 for the long put.
Correct.
Which, okay, may explain. See, I have about $130 loss if I were to close the position right now.
Right, and here's the reason why. You put on a put spread and the stock went way against you. So, and then half of it was assigned. You've made money on the long put, but it's still similar to us closing out a bull put credit spread, for example, that stopped out. So yes, it's going to be at a loss. So I think your goal now is just to minimize that loss. But since I don't think you're kind of near your maximum loss right now because the stock can go up $5 and you have the same loss. It can go down $5 and you have the same loss. So you're kind of at your maximum loss right now.
I don't quite follow that.
Yeah, it's Morgan Stanley. She's in. All right, look, so if you're long, look, a $57 put is way the heck up here. So you're long a put, but you're also long stock at what was your cost basis? $53?
Yes.
Okay, so under $53 at expiration, what's going to happen? Your put will be assigned because it's in the money, And so in your brokerage account over the weekend after expiration, then those two positions will disappear. $57 will come into your account, a share. So $5,700 is going to hit your account, and your 100 shares is going to disappear. So it's a wash.
Why is that going to happen?
Because that's what the league, that's what you being long a put at $57 means. You have a married put right now. You're long stock and you're long and in the money put.
Yeah.
So so now I gave you a scenario if it's under 53. If it's over 57, what's going to happen?
I don't follow. If it's under 53, I have the right to exercise, don't I?
Yes, but it's going to be automatic exercise if it's 1 penny in the money. So as long as Morgan Stanley closes at $56.99 or lower, it's going to be automatic assignment. Now, if you don't want automatic assignment,
I'm sorry, I don't understand automatic.
What does being long a 57 put mean?
It means that I have the right.
To
I do
what?
not have an obligation.
That's correct. Keep going. Keep going. You have the right to do what?
To sell my shares.
At $57 a share.
Yeah.
If Morgan Stanley is at $50 at expiration, why would you not want to sell it at 57? There's $7 of intrinsic value. So the brokerage firm, in accordance...
My expiration on the long is in July.
Correct. I'm talking at expiration right now, July 20. So the OCC, the Options Clearing Corp, rules tell the brokers that if it's 1 cent in the money, it's automatic exercise. Because what if you're on vacation and you have $7 of intrinsic value? So they're
a quick aside here. Doesn't the exercise of a right vary from broker to broker?
No, does not.
No.
OCC rules. And Greg, I'm helping her here, but I also don't want to tie up valuable trading opportunities, so please interrupt or type.
There's nothing going on here, Dan.
Right,
Things
right,
are just whipping back and forth.
Right. So just type and give us a heads up on anything.
This is awesome help. Please continue.
All right, go ahead, Lita. All right, so the last question was, do rights vary? No. If you're long a put, you have the right but not the obligation to sell stock at the strike price on or before expiration. You could call your broker right now and say, please exercise my right to sell my Morgan Stanley 100 shares at $57 at the end of the market. Which
I want to do because there's...
And I said I would not do that because you are giving up the time premium, and typical, like at Thinkorswim, TD Ameritrade, giving an exercise notice costs $35. Whereas if you were just to close this position, it's going to be less commissions and more profitable, because even though it's deep in the money, there should be a few pennies of time premium left. So that's why I was saying, do not give an exercise notice.
Okay. Well, your thinking is to hold the shares.
No, I didn't say that. So let's back up. You are in a mildly bullish position right now,
Yeah.
but you're at a small loss because the stock went down. It didn't go up. So let me give you a different hypothetical now. Let's say at expiration, the stock is at $60. Tell me what the brokerage firm's going to do. And Dan, you can answer too.
I would have said they'd do nothing, but
And that's correct. Why?
because it's out of the money.
Yes. Yes. So then you will own 100 shares at $60 and you'll have a very nice profit on your hands, and the short put at 57 bucks will expire worthless.
Yeah.
So the reason I'm asking you that question is we're trying to come up with a decision of what is prudent to do right now. So what I'm telling you is, or suggesting to you, is you have a bullish position that went against you, but it's not hurting you anymore because you've already kind of suffered your max loss. So trade the charts. If you think the charts are going to go higher, then you would do nothing because you aren't going to get hurt anymore with your long put. You're fully protected. Let me see what intrinsic value is left in the 57s. Give me 1 second here. So the July. So your mistake, in my opinion. Yeah, see, there's no intrinsic value. The 57 puts, actually, they're too spready. But on the call side, it's 0 by 4 cents. So that's telling me that there's no intrinsic value. So now my recommendation to you is do absolutely nothing. Maybe you get a gift. Maybe, the whole financial sector rallies, or maybe Amazon will buy Morgan Stanley for 60 bucks a share. Yeah, there's nothing to do. You've hit your maximum loss. You aren't going to get hurt anymore. And if you get a gift, meaning a robust rally, then you have a lottery ticket, so to speak, if it goes higher. So, and now, Dan, thanks for that information. He's saying the fees are only 20 bucks at TD, and I don't know where your brokerage firm is, Leadham, but Schwab. Okay, so find out yourself. Just go to their fees tab on their website and see how much it is for an exercise notice, as opposed to you'll have to pay 2 commissions to close this. One to sell the stock and one to sell the put, and compare the two. And you can then make that decision on expiration day. Okay, so it's not going to be a big difference. So now my recommendation to you is, since there's no time premium to salvage, is do nothing and hope Amazon buys Morgan Stanley. So the reason you have a small loss is because you had a bull put credit spread, which is a bullish position, and you didn't stop out. See, under here, under this $50 level, you should have stopped out of it. And then I don't know your scenario at the time, but you would have had less of a loss and possibly even a gain. So that, I think, was your trade review takeaway, that you didn't stop out of a bullish option credit spread. So now you've hit your maximum loss, like you said, 138 bucks, and there's nothing to do. You only have upside. You don't have any more downside. You have a lottery ticket. I mean, this has to get over 57 bucks for you to, cash in on your lottery ticket. So that seems pretty unlikely by July 20, but so what? Just leave it. All right. Did that now answer everything?
Thank you very much.
My
Yes.
pleasure. And anybody else following along have any other questions on this subject or anything else? Dan, well, thanks for checking that. That was very nice of you.